Hello there, many thanks for joining us on this morning's breakfast show. It's now time to bring you the feature on the show today. Now, we're following reactions that have trailed the most drastic move for this quarter. The Monetary Policy Committee meeting of the Central Bank of Nigeria has raised the monetary policy rate to 13% from the previous 11.5% benchmark. Now, this fresh move tilts to the earlier narrative analysts had projected of a rate hike of at least 25 to 50 basis points. Now, the governor of the Central Bank of Nigeria, Godwin Emefiele, describes this as the best and compelling move to tackle the most urgent issue of inflation. According to the CBN governor, other key parameters have been left unchanged, with the asymmetric corridor at plus 100 minus 700 basis points, cash reserve requirement at 27.5%, and liquidity ratio of 30%. Well, joining me to break down the details of the two-day deliberations of the Monetary Policy Committee of the Central Bank of Nigeria, the domestic and global outlooks, as well as the outcome of the just concluded meeting, I have Johnson Chukwu, the Chief Executive Officer of Carry Asset Management Limited. Thank you very much for joining us on the breakfast show this morning, Mr. Chukwu.
Thank you, David, for having me. Good morning.
Now, this latest 13% MPR rate is quite a sharp move away from the conservative stance we've seen the Monetary Policy Committee hold. We have consistently seen the retention of rates at 11.5%, and the biggest word of the season, which is forcing a change now, is inflation. Do you think Nigeria joining economies like that of the United States to tighten monetary policy rates is the best move, really, now to rein in inflation? And did this hike benchmark come to you as a surprise? Many had forecast about 25 to 50 basis points increase, at least. But here we have a whooping 150 basis points.
Yeah, David, the increments, the very hawkish position of the Central Bank Monetary Policy Committee came to me as a surprise. And these are my reasons. The factors that you can use, or the tools you can use to fight inflation in the US or in more advanced economies that are consumer-oriented economies is different from the tools, or are different from the tools you use to fight inflation in a country like ours. Granted that we've seen an uptick in inflation globally. The US had an inflation rate of 8.5%, the highest in decades at the end of March. And even UK had an inflation rate of 9% in the month of April, which is one of the highest. In Nigeria's case, we had an inflation rate of 16.80%, an increase of about 90 basis points, which granted that increment was quite worrisome. But for the Monetary Policy Committee to now adopt such very drastic hawkish position to increase monetary policy rate by 150 basis points, for me, it came as a surprise. The reasons are this. Nigeria's economic growth has actually been slowing down, or economic recovery has been slowing down. And if you look at those factors that propel the economic recovery we're even witnessing today, they are the sector that will most be severely affected by an increase in the cost of borrowing. Because in Nigeria's case, it's going to be a situation where productive activities will be stymied as a result of increase in cost of borrowing. In other countries, in other Western countries that are consumer-oriented, when you increase monetary policy rate, what you do is to slow down consumption. And that is basically saying that, look, it is either a supply-driven inflation as you have in globally today. So if you slow down consumption, you want to arrive at a new equilibrium between supply and demand. If you increase the cost of borrowing for consumers and you slow down the amount the quantity of goods and services they will demand for, so you arrive at a new equilibrium and you see a moderation in prices. But in our own case, we're dealing with supply shocks, but not just externally induced supply shocks, even locally induced supply shocks. And that is coming from insecurity we have in the northern part of the country that is actually affecting food production. So, and food items are basic necessities. So even if you increase the lending rate, in the first place, Nigerians are not consuming from credit supply. They are not buying their goods and services because they are borrowing money from banks. They are spending their income. So you really can't slow down their consumption by increase the cost of borrowing because they are not borrowing to consume unlike what they have in other countries. And that's why I said I was surprised that we are adopting exactly what Western economies have adopted without looking at the peculiarities of our own environment.
And contextualizing the issues here in the country, the pressure of the Russia-Ukraine war from the energy crisis to wheat, among other commodities, and also the volatility in the currency market were part of the table of agenda. The reality remains that we are still dealing with the heightened, lingering issues of COVID-19 and more. What is your take on the MPC scope of discussions for this month of May, the perspective the committee tackled them from, and then do you see any new twist as we keep our fingers crossed till the next meeting? Really, this is a tough time for the global economy. We cannot say what the next shock or disruption will be.
Yeah, the key thing is that the global socio-political environment is in a state of flux. And what do I say? So you really can't predict what will happen further in the war between Ukraine and Russia. We've seen situations where the Western nations Russia has cut down gas supply to some Western economies and has compared those economies to start buying, paying for gas with ruble, which means they will have to buy ruble with dollar. And effectively, the attempt to deny Russia of access to dollar will be frustrated by their position, because they can't exist without. Today, most of those countries cannot effectively operate without gas supply from Russia. Only a day or two ago, the U.S. president threatened that should China invade Taiwan, they will join the war. So as it stands today, we are living with a very volatile and unpredictable global socio-political environment. So you can't say what will happen in the next 2 months. And again, as the war is evolving, supply shocks will continue to be there. You're still going to have a tightness in the supply of refined petroleum products, which has had a major impact in inflationary pressure globally. And in Nigeria's case, even our inflationary pressure is muted, because we are not buying some of the petroleum products at their market prices. For instance, PMS, we still have that heavily subsidized. If that had not been subsidized, today we would have had a much higher inflation rate. Then at the local environment, you are dealing with insecurity in several parts of the country. You are dealing with political spending as a result of upcoming primaries of parties, and then subsequently you're going to have party campaigns. So you're going to see local currency improve in terms of circulation, because many of those who are involved in political activity will be paid stipends to be part of the political process. So you're going to see local consumption of basic items, food items largely, will increase. Clothing, basic human necessity, because that's the level of our consumption, will increase. So without a commensurate supply of food items, you are going to see a situation where food inflation will continue to persist, and possibly core inflation will also move up. So I think on inflationary pressure, we're going to see a lot more domestically induced inflationary pressure, and even the increase in interest rates will not have any effect. Like I said, our consumption is not driven by credit, because we don't have consumer credit in the country.
We have less than 1 minute to wrap up this conversation, but this hawkish move now by the Monetary Policy Committee, how much of an extent do you see this also affecting the GDP the GDP figure for the second quarter of the year that would see? We have the first quarter GDP report,
that's actually my greatest concern, because if you look at it. Okay, David, can you hear me?
Yes, I can hear you loud and clear. How much of an extent do you think this hawkish move by the MPC would have on the GDP forecast we'll have for the second quarter of the year?
Yeah, that's actually my greatest concern, because if you look at the trend in the GDP figures in the past 4 quarters, in the second quarter of last year, the GDP grew by 5.01%, only to tap out to 4.03% in the third quarter, and dropped to 3.98% in the fourth quarter of last year. And the first quarter of this year, we saw a GDP growth of 3.11%. So with the Monetary Policy Committee stepping on the brakes, slowing down economic activities, and particularly focusing on those areas that are driving GDP growth, because they consider them as non-essential, non-critical sectors of the economy, you could see a further decline in the GDP growth rate. And that's, for me, is why I said I was surprised that they could take such a very hawkish position.
Exactly. Thank you so much for your time on the Breakfast Show this morning, Mr. Johnson Chukwu, the Chief Executive Officer of Cowrie Asset Management Limited. We'll definitely have a bigger conversation and keep our fingers crossed as to the latest intricacies that redefine how well the Nigerian economy bounces back. Thank you once again for your time, and do have a wonderful day ahead.
My pleasure.